You're listening to Inside Real Estate, your source for all things mortgage and real estate related. The show that brings you all the hottest topics and insights directly from those who know it most. Now sit back and enjoy the show.
What is up, everyone? Paul Apostolakis, Salvatore Kuzmano, Brad Weisgerber. We are Inside Real Estate. Thank you for joining us for another episode of our show. For those of you that are listening, thank you for finding us. Those of you that want to follow us, please like, share, subscribe. Find us on irepodcast.com. You can go to Facebook.com/IRE Podcast if you want to see us live. Go to YouTube or any podcast app that you decide to use, even Amazon Alexa. You can find us on Alexa.
Alexa,
don't do that.
How many people are listening right now? Their Alexa just went off. Alexa,
nobody's listening.
Yeah.
Brad, your eyes look horrible.
Yeah, they feel horrible. Thanks.
Brad might have the COVID, but somehow it's attacking his face.
Yeah. And my chest and my head.
Yeah. So today we've got Mr. Tory Sheffer on the show. He is owner of Sheffer Capital. He's a serial entrepreneur. He was here in Michigan. He's since moved, but he is still doing his thing with Sheffer Capital. He owns that and he manages it. He has been in the industry for 6 years as a broker, principal investor. He's done over 100 transactions, $100 million in volume. He's also an investor in Real Estate Lab, which is a real estate software company focused on analysis and data related multifamily investing. Without further ado, let's get Tory on the show. I want to get his perspective on the market. How are you, sir?
I'm doing great. How are you?
Good, man. Obviously, you've been on our show before, but in a different capacity. You're kind of doing it.
See you guys again.
Yeah, it's been a while. So why don't you talk to us a little bit about what you did, what you've been up to?
Yeah. So what I've been up to is kind of always a long-term goal of mine since since I found out about it was to get into multifamily and get into the commercial world and more of the owning all of this real estate rather than just being the sales guy chasing the next deal and the next deal and the next deal. To get into a position to own it and not have to, and not that it's not get up and work in the morning. Obviously, you get up and bust your butt in the morning for something a little different. But in 20, 30 years, I can retire or whenever. Compared to as a real estate agent, you can't quit until you just got to put enough money in the bank deal. Or
Yeah,
so
you gotta get that next deal.
Never ends.
So can't quit until you can't open the door to show the house anymore.
Right.
Yeah, exactly. I mean, that's what the average age of a real estate agent is. What I think, like a couple of years ago, was a 57-year-old lady. But
Correct.
It's common to see people in their 70s selling houses still. But
correct.
They can't quit.
Correct. They can't quit. So you decided to go in the multifamily investing world, which is interesting. How did you even get into that? How did you start doing that?
So I started doing it. I mean, I started learning about it from podcasts and books and everything. And then in 2019, I basically, I don't know if I had my show before, but I talked about doing mailers. So I used to do a ton of direct mailers to owners of houses and just, I'd target a, certain price level and say, hey, I want to sell your house. Or if you're interested, call me and sell your house. So in 2019, I turned all of that back over to finding apartment buildings to buy. And I just created lists of apartment owners and would send that out to them and just say, basically, hey, I want to buy your apartment building, but in a little bit more complex version.
Yeah. So how did you raise the money to buy all these properties? Were you just using your own funds or did you leverage?
No, yeah. So the first one I did was 232 units. It was like roughly 16 million. Didn't use any of my own money. But what I did was I found the deal and then I knew a guy that had been doing it for a couple of years. And so I brought the deal to him because I knew that they would be able to buy it and raise the money and get the loan and all that. You were right. I didn't really know much of anything at that point. So,
right.
So I brought it over to them and we bought, we were planning to buy all 232 and then kind of halfway through our due diligence process, we had someone else approach us that wanted to buy a ton of them. So I think we sold, we ended up doing like a double closing wholesale for 184 of them for $1.4 million over what we had into them. And then we kept 48. since then we sold 28 of those. So we just have 20 left from that original deal. But we sold the 28. We were all in for like 2.4 million. We sold it for 3.7. We did a 1031 into a 52 unit right by Beaumont. And then we have the 20 unit. We had it on the market. I think we were all in on the 20 unit around 2 million. And we're doing a refinance right now on that. That's going to close, I think, beginning of next month for roughly, it's like just shy of 4 million.
Nice. So you're raising capital that way too, because you're leveraging the properties that you actually already got.
Yeah. So like on the 52 unit, we just bought that in October. We used a lot of 1031 funds and then our initial investor capital. So in the 28 units, I think we had $1 million of investor capital. And then when we sold it, we had $1.4 million of profit. So we had 2.4 total. So we moved that over. The 52 units we bought for 5.6. And we didn't have to bring any additional capital. And then, other deals, like I have a 24 unit in Fenton, 33 in Linden, 16 in Holly, another 8 unit in Royal Oak. And a lot of that is a mixture of friends and family money, but then also I have a newsletter that I do, and I have a decent amount of investors from there as well.
That's awesome.
Those are a lot of big numbers. Like how do you one day wake up and be like, I want to spend $16 million on this apartment building?
Yeah.
Like that's a big number, especially when like you've never done it before. Like you said, you didn't really know what you were doing, and you didn't have $16 million. Why? What makes you be like, that's a good idea? What does that thought process look like?
I don't know. I mean, I've always been kind of like the type of person that like does something and then figures it out. But on the $16 million one, so I sent a mailer out to like all the apartment or kind of the targeted apartment owners in Metro Detroit. And I think I sent out like 500 or so letters. And this letter hit on a 56 unit. And the broker emailed me, and it was like a broker family friend. It wasn't listed. A family friend of the owner. The property had never been sold before. So this was the kids of the original developer from like the 50s, 60s, and 70s who built all of these properties.
Yeah.
So the broker, who was a family friend of the owners, emailed me and said, hey, we have, so it hit on the 50, it was a 56 or a 52 unit in Farmington Hills. I forget exactly, but he said, hey, we have 11 other properties. Do you want those too?
Wow.
And I was just like, yeah, for sure. And, I don't, at that point, I don't know, but I'm going to, if you say no, then you don't know. So,
right.
I said, yeah, for sure. Send everything over. So he sent me all the financials, and I did the underwriting, and it was a sweet deal. And then I remember I was at our hunting camp. So it was like the day before opening day. And I sent out the initial LOI for like 13 or 13.5 million. And I think I had like 50 grand in the bank. At the time I was an agent. So I was selling like 8 to 10 million a year.
Right.
And that as an agent, you net somewhere in the high 100s roughly. So I wasn't rich, but I wasn't like dead broke. But I knew I figured I had the connections if I needed to find the money. So it ended up we had 200 grand of earnest money on the deal. And then but that was all from my partners who I brought in once we got it closer and got it actually under contract.
Yeah. What is lending like in that world?
It's excellent.
It's excellent. Okay. That's not what I expected to hear, but okay, let's talk about that. So why is it excellent?
Well, because it makes sense, right? Like if you're going to buy a house, it's the craziest thing. So if you're going to buy a house, I guess in general, all they care about is debt to income, from what I understand, right? I'm not you guys are the lending
experts. A big piece of it. There's probably 4 pieces.
The borrower more than the property, right?
Yeah.
The borrower.
It's all about the borrower.
Property.
Yeah.
Yeah. So on commercial, it's the property first, and then it's the borrower. So, it's the property first, and then they'll want you to have net worth equal or greater than the loan amount, and then 10% post-closing liquidity. So 10% of the loan amount liquid after you close.
Got it.
If you meet that criteria, then they'll give you the loan.
Got it. And you did that with investor help, right? You said?
So on the first couple deals, I had other people sign on the loans with me, but now for all of my deals recently, and I just sign on the loan myself.
Yeah. So, and you say you underwrite them yourself. How do you do that? Like, what are you looking for?
Yeah. So what we're looking for, like, I guess if we're just focusing pure Metro Detroit stuff, everything is kind of like Royal Oak is like $2 a foot or maybe a little over for like the really good product.
Yeah.
But like in Fenton and Linden and Holly, I'm looking for properties that are rented for under $1 a foot, or like if I'm in Royal Oak, around $1 a foot, or low, maybe $1.25 or whatever.
Right.
And we know that we can go in and raise those rents because we own 80 units in Royal Oak.
Right.
We're getting, I think at our best property, we're getting $1,800 for a 2-bedroom, and those are, I think, 850 or 900 square feet. So,
right.
If I find a place that's $1.20 or $1.30 or 40 or 50 in Royal Oak, I know that I can get that to $2 through renovations. I know what those renovations are costing. And then it's just a math problem really from there.
Are you going in and renovating these properties? To be fair, you are, right?
Yep.
So you are renovating that. So that's another cost that you've got to incur. How do you finance that?
Yeah, so that's through the bank as well. So a lot of times, so like the last deal that I did, it's 8 units in Royal Oak, right by Beaumont. It's at Harvard and 13 Mile. What we did was we got a 80% loan to value on the purchase of the property, and then we got an additional 80% of our renovation budget covered. So I think our renovation budget is there. I'd have to go look, but I think it's like around 300,000 to maybe 350 or so. So we got 80% of that as the loan, and then we got 80% of the purchase price, which was $825 in this case, and then we just have to come up with that difference for the down payment and everything else
for the 20%, and that you're doing through investor help, right?
Correct.
Yeah. I get your newsletter. It's really interesting that like you guys are always looking at units, and you guys are always kind of making some moves. Is the market the way that it's set up right now? Is it set up well for what you're trying to do?
Yes. I mean, the big thing is the debt market is set up really well for what we're trying to do. The sales market it's not great. It's tough, but most of our deals are off market, right? So like the 50, I think it's 52 in Royal Oak, right at it's on 13 Mile. But we bought those from doctors. The other 8 units, I just bought that from a doctor. But it's generally it's going to be people who are not day-to-day involved, and that's like the 16 unit I bought in Holly. That was his only property, or he had a 4 unit in Royal Oak too, but he was an active multifamily real estate guy, because everyone that's kind of actively involved every day knows the market is nuts, and properties are selling at like 4.5 caps in Michigan and 5 caps, and
right.
Typically those would have been 7 or 7.5 and 8.
Right. So that's interesting. So now the biggest hurdle, I guess, for someone starting out, let's say someone's starting out in this field and they want to buy a property, the biggest piece of it is finding the properties that are eligible or that are going to make sense to do this, right?
100%. Yeah. So like that's the 8 unit. The guy that brought that to me, his name's Ted Plesh. He lives in Belleville. He was house hacking a 4 unit. He's always been looking to get something a little bigger, and he got this 8 unit on a cold call. And then he was basically in the same position that I was on my first deal. It's just different size, but he didn't know what he didn't know, kind of deal. So
right.
He brought that deal to me, and then he keeps a good piece of it, and I have a piece of it, and we go and buy it together, and then he's able to learn and see everything kind of along the way, and now he'll just go and copy and paste on his own for the futures.
That's interesting.
Same thing I did.
Yeah, that's awesome.
There's no like written playbook, right? Like you kind of have to ride with someone on your first deal, or potentially put yourself at huge risk for failure, right?
Yeah, and that's the other thing too, is that banks look at like your track record a lot too. So if you don't have a track record, then they won't lend to you. But if you're able to show them, like now we have 9 properties, 204 units, and not that that's like some crazy number, but on some of these smaller deals, like 8 units or 30 units or whatever, a bank is pretty happy to lend to us just based on that track record.
Yeah. What bank do you use right now to do this?
So I've used a bunch of them. So like I have Lake Trust Credit Union. I guess I'll name kind of Michigan ones you'll probably know. Old National Bank, we did a loan with. Lake Trust Credit Union. Superior National Bank, which is also, I think, their Main Street Bank, Metro Detroit area.
Yeah.
And then there's a bank out of Indiana that we used on a couple deals. And then I have a 30 unit in South Carolina, and then I have a couple projects down in Texas. So we have different lenders on those. But like so South Carolina, we have a credit union down there too.
That's interesting. That's really interesting. So you're not just going to one place. You're kind of looking for the best terms at the time.
Yeah. So you go out and get quotes on them, and it's kind of like the different thing. Like if you're in residential, I guess kind of my experience was when lenders found that you were shopping them, they would kind of get pissed off and be like, I'm doing a good service. I didn't do much with you guys, but I don't know how that was. But a lot of the lenders that I worked with was they would kind of get angry about it. But like in the commercial world, they just know that their rates are getting shopped.
Right. Right.
So, they'll literally send a term sheet, and people are, sending 3-4 term sheets to the next lender saying, hey, can you beat this? And, it's a little cutthroat, I guess, in that nature, but it is a relationship thing too. And then it comes down to, can that person get that loan closed for you too? So it's not just a pure numbers game, but like the last deal we did with Superior National, it's on the 16 unit, it's in Holly. Let's see what the terms are. We did 80% loan to cost on that at 4%, with a 20-year amortization, but we had 18 months interest only.
Oh, wow. And
then my other option was Old National Bank, and it was 75% loan to cost or loan to value. I forget exactly which one. And that was, I think, also 4%, but no interest only, and 25% or 25-year amortization.
Wow.
So you're able to take those numbers and say, a 20 or 25-year amortization on the loan, that's obviously going to make a difference on your cash flow. So you just go through and compare what's going to be better for the investors. And the nice thing is I just plug all that into the model, and it tells me what the best option is. And those options, I mean, they sound different, but they were within 1% of each other on the returns.
Oh, okay. So which one did you end up going with?
Superior National.
Superior National. Okay.
Yeah. So you said earlier that you bought a big property, right? And then you sold a bunch of them off. Is your goal to buy them, fix them up, and sell them? Or is your goal to hold them and collect the rents long term?
Hold them. Yeah, hold them and collect the rents long term. We didn't intend to sell off that first big package, but it was just it was in the middle of COVID, and we had someone that was basically going to pay us what we were modeling out to be 2 years worth of income that we would have made from that property. And at that time it was like, all right, this is worth taking, kind of like what's that saying? Like a bird in the hand or something like that.
Bird in the hand, one in the foot. I don't know what, something like that.
Two in the bush.
The two in the bush.
In the bush. Yeah. So we figured, hey, if we can get 2 years of income that we see that we would make on these properties right now, day one, and there's no risk on our end, that's excellent. And I think our total cost into the project, which none of it was mine, but the total cost in the project was like $200,000 in legal fees. So it was,
oh wow,
200 to $1 million for. That's a not bad return in 9 months.
No, not bad at all. But legal fees were $200,000.
Yeah, I mean, lawyers are expensive, and they do every part of the contract, and you're doing your operating agreements or your PPM, private placement memorandum, and then all the purchase agreements, all the closing docs. So the title company does a lot less in the commercial world. They're the attorneys are drafting all of the closing docs, drafting everything, and then so a typical like even the 8 unit, so the attorney fees are on there were like $10,000.
Yeah.
But that's pretty typical, but attorneys are $400 an hour and they put, whatever many hours into it. So
maybe
it's not cheap.
Yeah.
They just got templates, fill them in, shoot them off.
Yeah. How do I sign up for that?
500 hours into this project.
Right.
Yeah, no, and it's crazy. I've talked to a few, like my attorney, I use a Honigman in Detroit. But I've talked to some people who, they're paying $600, $700 an hour. And, it's one of those things I feel like you get what you paid for. A good attorney is worth a lot of money.
Right.
And kind of, I say an expensive attorney is cheaper than a cheap one. Because the cheap one might miss something, or they might cut a corner, or whatever the case may be, trying to save a buck, and it'll really get you down the road.
The biggest, or at least the biggest reason for an attorney is because you're buying essentially, tenant occupied property, or is it more like just between you and the seller?
Well, it's a little bit between you and the seller. It's a little bit because you're buying an occupied property, but in a lot of commercial deals, there will be like I forget what you call it, but basically, like if something comes around in 6 months or in a year that the seller didn't disclose or something of that nature, you can go back after the seller quite a bit. Where in a house, there's almost nothing that you can go back for. Right. You sign at a house closing, you sign a form. I think it's titled maybe as is, whereas hold harmless. Yeah.
Hold
so
harmless.
Like, okay, I inspection, I'm not doing anything else, and is what it is. So, but on commercial, there's a lot more kind of that goes into it after the transaction, but then before the transaction too. And then, they do zoning reports and all of this other stuff.
So the attorneys more or less just doing your due diligence for you to a degree with all the legality and.
Yeah. And they review the title, and they're doing like, the title and ownership
Part
due diligence, and they'll order a zoning report, which, we could order a zoning report, but it's easier. They just have a streamlined process. Okay, well, this is what we do every time. So
that's interesting. So it is a pretty complicated thing that you have to figure out. It's not just like, hey, I'm going to go buy this property and just like, it's cool. Right.
Yeah. I mean, you could, but you may not get covered all the way. Yeah.
Yeah. So how would, let's say someone wanted to get involved, or someone wanted to get started in what you're doing. What would be the best way to do that?
Cold call. Yeah.
Just cold call. Just get out there and make as many cold calls as possible.
Yeah. No, I mean, I guess it's a lot of cold calling, but obviously kind of know what you're talking about. Listen to books, listen to podcasts, kind of talk to people that are doing it, and kind of, and network heavily too. That's a huge part of it, right? On my first deal, if I didn't know the guy who could go and buy that deal and have the earnest money and all that, I never could have done it.
Right. Like, did you have him lined up before? Or did you find the property and then say, "Oh shit, I got to find someone to buy this"?
Yeah, no, I knew him before, and I had been kind of looking for a deal that I was like, all right, that was always my plan. It's like, if I find a deal that's good, I'm going to bring it to them. If they hate it, then I'm going to have to find some other option. But that was plan A, and it just went exactly to plan.
That's awesome. That's really awesome.
Have you considered hiring like students, essentially?
Yeah, like you mean like to do coaching?
Like under Sheffer Capital, right? Like, or like an intern, or like, essentially employees that you can kind of groom and go out there that, obviously you're busy already with a lot of deals you have, right? Which takes away from the time that you could probably cold call on some, right?
Yeah, I'd love to be able to cold call more. That's what I've kind of always done was cold calling. So it's a lot of fun. But yeah, I mean, I've been looking for it. I haven't hired anyone yet, but there are a lot of people that are just kind of out there. Like even my younger brother, he's in college right now. He's 20 or 21. He's looking for deals. He's cold calling. So I sent him a list of properties that we want to buy, and with all the information, and said, hey, call these guys, and if you find one, great. If you don't, oh well. He's doing other stuff, so it's not his only job, but it's kind of a way that he wants to get into it. So it's like, all right, you want to get into it? Here's a list, go call them.
Right. That's interesting. And then he'll bring it to you, and you'll set up the deal for him, and so forth.
Yeah, so he'll bring it to me, and then typically if you just find the deal, then it's basically just pass it off and ride the coattails, and then you'll kind of see everything along the way.
Right.
And then I have a spreadsheet kind of like how you split it up based off what, different people are bringing to the table. So whether it's asset management or risk capital, so like earnest money and legal fees up front and all of that, and then able to sign on the loan. It's all kind of mixed up on a percentage base of how you end up chopping it up. So typically if you just find a deal and bring it to me, that would be worth 10% of the general partnership, which typically a general partnership is going to be worth anywhere from 30 to 50% of a total property value or total equity in the deal, I guess.
That's a pretty good bird dog fee.
Yeah.
It's a great bird dog fee. Yeah. And, sometimes
on 1.5 million, right? 140 Gs, 150 Gs.
Yeah, no, it's not bad. And then the other thing is that, you find a deal and then you get a little bit of equity in that deal. So then you're able to start building a net worth. So then down the line, you find another one, maybe it's $1 million, and now your net worth is $300,000. You don't need to, bring in someone that's so big or whatever. You just have to bridge that gap.
Yeah.
Is there a lot of partners who, because there's so many people involved, right? And as you know, this business can be up and down depending on who you got in there, right? There's a lot of people who probably like throwing in half the money they have saved, right? And then there's other people where they just got money on the sidelines looking for, good deals to ride. So you ever have investors say, hey man, I need out, buy me out?
I haven't yet. I've heard it happens. Obviously it's not the most crazy thing in the world. You look at 2008 or, just The Big Short. That's all it was, hey, give me my money back. I need my money back. Really bad.
Right.
But, times are really, really good right now. So it's, you don't see a lot of that stuff when times are great, but yeah, it's definitely is a possibility.
Do you see, go ahead, Tory.
I was going to say, my biggest thing on investors is we're buying these deals with the intent to keep them forever. So anyone that invests, I make it very clear up front, don't expect your money back, in a year or in 2 years. A lot.
Oh, we lost
back in 2-3 years.
There he is. Yep.
Okay, can you still?
Yep.
Yeah.
Yeah. So a lot of them will plan to go in and do the renovations, do the value add, and then refinance in 2 or 3 years. But that's no guarantee. If the debt market is horrible at that point, then we're going to wait until it makes more sense. So there's no guarantee of set time. You're going to get your money back on this day. It's we plan to hold them forever, plan to not need that money ever. And it's just a 30-year horizon.
Right. But you're still making money off the rent, right?
Yeah, exactly. So we do quarterly distributions and, you still make money off the rent.
That's interesting. Rents going up the way that they have been over they're up, way up year over year. It's got to be playing well into your hand.
Yeah, it's been excellent.
Yeah, that part of it. Now, what about rising rates? Are rates at a point yet where this doesn't make sense? What point does this start, the rates start hurting the cash flow?
Rates would have to go up probably 2%, I think, to have a drastic impact.
Yeah.
Which that's 50% from where they're at right now. So,
right.
If a 0.25% or a 0.5% is going to kill your deal and make it not worth doing, then your deal sucks in the first place.
Right.
Debt is not the key to a deal. A deal should be able to live on its own if you were to buy it cash, but then debt is just leverage to get a higher return.
Right. That's interesting. So rates are going up, but in your opinion, there's still room to ride.
Yeah, and it's in the deals that I typically look at, right? Some people, I tried to buy this deal out here in Phoenix, and it was a 4 cap, or I tried to buy it at a 4 cap, which is so in theory you buy it and you're going to make 4% on that purchase price a year.
Yeah.
So I offered 15 million or 15.3 million. And the broker emailed me back and he said, hey, we have 4 people going to best and final. They're all over 24 million.
Wow.
So
that's a big difference.
I missed by 9 million, but they're buying at a 2.5 cap.
Okay.
So like their interest rate on that property is probably going to be, so like you think 2.5, okay, they're going to make 2.5% net income on this property. Now they got to pay their loan, right?
Yeah.
So they got to go get a loan for, I don't know if people are still getting 2.5% commercial loans right now. So they're probably going to be in a negative leverage position for, at least a year or 2 years while they raise the rents. But that's just a crazy risk deal that I wouldn't do.
That risk is too high in your opinion.
Yeah.
Got it.
Yeah. I mean, if rates go up and you can't hit your rent targets, then you're screwed.
Right.
It's
so
interesting, right? You're essentially buying a business when you buy a property, right? And someone, why would they sell, right? And other ones are like so mismanaged, and they may not have the the know-how and or the effort to make it happen, right? Or capital.
Yeah, and so like that's the 8 unit in Royal Oak we just bought. The guy didn't even have insurance on the place, property or liability, no insurance.
Insurance,
none.
So ticking time bomb.
Yeah.
So when you get into these properties, are they all rented? Is someone managing the buildings already? How do you manage the buildings itself?
Yeah, so I have a management company that does all of that. So they handle like the day-to-day aspects of that. And then they're typically all rented or like 80% or more. The one I bought one in Fenton. It was 24 units, 10 were vacant at closing. But we worked it out with the seller where he paid us 7.5 months of rent for everything that was vacant at closing. So that gave us basically full economic occupancy while we went and renovated those vacant units. And then we got it done in quicker than 7.5 months. We got double paid for a few months.
Oh, that's nice.
So that's really nice. What do you like, when you're renovating a complex, right? And the units are occupied, what do? Do you end the lease and try to time the renovations, or do you put them elsewhere? Or like, you know what I mean?
Yes. So it's a mixture. So it depends on the lease. So most times, if they have a 12-month lease, we'll do it once their lease expires, and we'll give them basically an option of a renewal at just below our market rate or our full. Usually our goal is to go in and renovate all of the units, right? No matter what. So we'll usually give them an option. Like if, for example, in Royal Oak, right, the rents going in were like $850, and we wanted to get them up to, I think we started at $1,650 for the 2 bedrooms, and we knew we could hit that number because we had already done it. So we send them a renewal, say, hey, we can't afford to rent this unit for $850. It's got to be rented out for like $1,400 minimum, or we're going to go in and renovate it, and we'll renovate it and rent it for $1,650. If they have a 12-month lease, we'll do it at the end of their lease term, and we'll just send a non-renewal 30 or 60 days prior to that lease expiring, and just say, hey, we're not going to renew your lease. We need the unit back so we can renovate it. And a lot of times we'll get people that will move from the same building from an old unit into a renovated unit because they want a nicer product.
Yeah. So they're just upgrading within the building.
Yeah.
Oh shit.
So it could be like, after purchase, like up to, year and a half, 2 years before you have all the units renovated.
Yeah. Yeah. Usually if you do it on lease terms, it will take, like in a sub 100 unit building, it'll take, or like sub 50 unit building, it'll be like 16 to 18 months to have 100% of them turned.
That's awesome. Where are you getting your list from to cold call? Like, let's say someone wanted to do this. Are you just looking at Googling? How are you finding all your people that you're looking for?
So the biggest spot I find stuff is CoStar.
CoStar.
So it's basically like the commercial MLS, but they have all of the property owner info, or I found them to be pretty accurate. They're not dead on, but
right.
So they have the ownership info, and all of these, or most of these properties are in an LLC, And so they're actually able to, they go and find who owns that LLC and who's the actual person that's going to make that decision. And it'll have either their home or office address, and you're able to, get their address. So that's like when I sent the mailers, that's how those got to them. And then a lot of times it will have their, maybe a cell phone or a home phone or whatever phone number they have listed on different public sites as like their contact info.
That's awesome. That's really awesome. So,
I mean, I know you said you generally send a letter like, hey, I want to buy your place, right? But like, what details do you say, right? Like, do you put together like a potential pre-offer or anything? You just say, let's talk.
No, yeah. So what I do is kind of the first paragraph is an intro to who I am, and so it's like, hi, my name's Tory Sheffer, and owner of Sheffer Capital. We focus on apartment buildings of 20 units or more, built 1970s or later, in these areas, right? And we're looking to buy your property located at, and then I put their address in there, and then I have a list of like 4 or 5 past deals. So I say, here are some deals that we've done recently just to show that, hey, we are qualified to buy this place. And then I have like a closing paragraph just saying, hey, thanks for reading. We can close in 30 to 90 days, or if you need to delay the closing to do a 1031 on your back end, we can push the closing off or whatever, and just kind of offer it up as like, hey, we're flexible, but if you're interested in selling, give us a call and let's chat more about it.
That's awesome. That's awesome. Any advice for someone that wants to start doing this?
I would say start doing it.
Start doing it.
Yeah. I mean, it's kind of the, and I guess it depends on what type of person you are, right? But I guess anyone that's going to go and start doing it is probably going to be a little bit more type A and kind of a driver type personality anyways. So, start going out and looking at apartment buildings. You see an apartment building come on the market, call the broker, talk to them, see what they think about it, and get a lot of information that way. And then you start to realize kind of the language of the multifamily world and what to, what kind of terms people are using and what they're saying and talking about it, why they like a deal. There's like a lot of little nuance that goes into it. And if you're dealing with a broker, they'll know right away whether you have done this once or have never done it before. Right. Just because some of the terms are just foreign to a lot of people that aren't in this world.
Right.
So when you say the broker, you're saying like whoever's selling a property, right?
Yeah.
Like if it's listed, right?
If it's listed, yeah. So if it's listed, right? If I go call a guy, he has the listing, and I'm going to ask him some questions. He's going to know based on my questions if I've ever bought a property, essentially.
Right.
Yeah.
Because you'll know the right questions to ask. You'll know, the right terms to use and what to say and kind of what it really just becomes natural conversation, but it's no different than I always compare it to like an engineer. Like a lot of my friends are engineers and they'll be talking about all this stuff. It's like, I don't have a clue what you guys are talking about.
Right.
So right. It's just kind of like the it's no different for loans, like debt to income. When you go talk to Joe Blow down the street, you probably don't know what debt to income is. He's like, what's that mean?
Right.
So.
Right. That's really interesting, man. Well, congrats.
I'm going to have you call Tory.
I know.
That's great. I love cold calling and find a deal. That's my favorite part of it for sure. So
yeah, putting it all together. Well, congrats on all your success, man. It's awesome that you've gotten into a whole new kind of world and you're kind of thriving in it. So that's awesome, dude.
Yeah, no, it's a lot of fun. Thank you.
Yeah,
it's been fun.
Let's get you. Let's do 3 questions and we'll get you going so you can get out there and find another property, I guess.
Yeah.
Okay. First question: if you had to eat one food forever, what would it be and why?
It would be ribeye steak. And allowed a side, I'd go asparagus on the side.
You'd eat that forever.
Yeah, I'd eat that forever every day.
Okay. All right. You guys have any questions?
Multifamily treating you good, Tory.
Yeah.
No, I mean,
I'm Burger King.
Yeah, no, I'm not eating that every day right now. So
yeah.
Room to grow.
You guys have questions, Sal, Brad?
If you could be like a fly on the wall of any historic event in time,
I would say I guess I don't know a specific event, but like a fly in the wall in Sam Zell's office when he was still working in Ann Arbor. I feel like would be a blast. I don't know if you guys has read his book, but he talked about how when they had like hundreds of millions of dollars of real estate and they were just cash broke. And he just seems like a wildly interesting guy, partly because he started Ann Arbor. But just to see the point that he's come, and I think that being a fly on the wall in his office would have been an absolute blast.
What book was that he wrote?
It's called "Am I Being Too Subtle?"
Okay, that's good. All right.
Yeah. Phenomenal.
Last question will be, what is if you had to get rid of one thing in your life that you could change, what would it be?
Boy, get rid of something?
Yeah, you can totally get rid of it. It could be a bad habit. It could be
bad habit.
A person.
I mean, I would work out more. I'd be jacked. but no, it's like I love chips, like just classic like potato chips or any chips. I'm addicted, and I would get rid of that because it's horrible.
What's your favorite chip?
A jalapeno kettle cooked.
Yeah. You'll do that. Yeah, that's Brad. You and Brad would get along great. He loves chips too, but Brad likes a lot of food.
The jalapeno kettle cooked are the best.
Oh, they're phenomenal. I used to sit down in college. I remember we'd go and buy a bag of chips and sit down and watch TV, and you just crush the whole bag of chips. It's like, but at that point, I had like excellent metabolism, and I could eat anything. I was 180 pounds, and I was eating like garbage. But
yeah, not anymore. It catches up to. How old are you now, Tory?
27.
27. You're doing really well for yourself at 27, man. Congratulations.
Years of chip eating. Still.
Yeah, you're all right. Yeah. Try hitting 40. I can't eat a chip anymore without gaining weight.
Yeah. Well, I don't know, Paul. You're in great shape.
Yeah, right. So, Tory, tell the audience how they can get a hold of you, man.
Yeah. I mean, I'm on all the social media platforms, Twitter, Facebook.
Yeah.
Not Facebook as much. Instagram or LinkedIn is going to be the best place, or Twitter. Twitter is actually great for learning too.
Yeah.
There's a ton of multifamily and just different real estate guys on there that they do all these threads about what they did and how they did it and all this stuff. It's actually been phenomenal. I've talked to a ton of like excellent people from there, like in person or calls or whatever. It's awesome.
That's awesome, man. Well, congrats on all your success, man. We wish you the best. We'll talk again, I'm sure.
Thanks for having me on.
All right, Tory. Have a good one, man.
Thanks, Tory.
Man, that's interesting. There's so many different ways to make money in real estate.
Yeah. I mean, what I think is really cool is we had him on the show before he did all that.
Yeah.
Right?
He was just a
luxury agent and was able to escape the kind of rat race that we're all in. You know what I mean? I mean, he's still in a race, right? I mean, there's always one, but it's just a lot smaller with bigger rewards.
Just different race.
Think back to when you were 26, 27. Could you imagine trying to go borrow $16 million to buy a fucking apartment building?
No.
It's a special kind of person.
He's a pretty smart kid. He always knew. He always had that in him. So
I mean, if you identify a deal, though, right, and you're able to present it, I mean, 20, you could be 80, right?
Yeah.
If the deal makes sense, there's money out there to fund it.
Yeah, totally. All right, guys. That's our show. For those of you that have listened in, thank you so much. Please like, share, subscribe our show if you're into it. If not, don't do anything. You don't have to listen to us. Go to Facebook.com/IRE podcast if you want to see us live, YouTube, all that good stuff, or any podcast app that you want to find us on. And we will see you next week. Peace out.
Bye-bye.
You've been listening to Inside Real Estate, the nation's top real estate podcast. Don't forget to follow us at irepodcast.com and everywhere where podcasts are available.